Hi, everyone. I'm Matt Clark, research analyst with Money and Markets, and joining me like he does each and every week for some reason. I haven't figured out why. I think he might like me. I really don't know. But it's Charles Sizemore. He is the co-editor of Green Zone Fortunes, and we are back with another episode of Investing with Charles. Charles, we're going to talk about stocks versus bonds. But first, I want to remind everyone that if you do have a question for Adam, Charles, or myself that you'd like to ask on any topic related to the market, to the economy, cannabis, because we do the marijuana market update, feel free to ask anytime. You can email us feedback@moneymarkets.com. We'll put that email address right down below here. It's feedback@moneymarkets.com, or you can comment down below on our YouTube page. And also check out moneymarkets.com. It is your home for safe, sound, smart, simple, profitable investment information. We try to find you ways to profit in any market condition, whether it's up, whether it's down, whether it's flat. We try to find those things for you. You can check out our proprietary stock power rating system and also sign up for our free daily emails. We've got Money Markets Daily, and also I'd be remiss if I didn't tout my own, which is Stock Power Daily, where every day of the week I give you one highly rated stock according to our stock power rating system and tell you why it is a good investment for your portfolio. Now, let's jump right into it, Charles. I have a question here. This is from George. George basically asks, comparing everything down the line, if you're looking for income in the market, which is better, stocks or bonds? Very simple question.
Yes. No, the answer is generally going to be stocks. Now, let me preface that. Bonds are safer in the sense that a company has to pay its bond interest before it pays its dividend. That's not optional. And a company can always cut its dividend. They reserve the right to cut their dividend if times get hard. They cannot cut their bond payment without triggering a default and winding up in bankruptcy court. So bonds are safer in the sense that the bondholder gets paid first. But in a healthy company, a good, strong, healthy company, that's obviously less of a concern. And if you're diversifying, if you're spreading your bets here across multiple healthy companies, then even if one of them does fall on hard times, you're covered. So with that as an introduction, yes, generally speaking, dividend stocks are going to be a vastly superior income source than bonds.
Now, we can do a little bit of comparison here, and you and I talked about this before we jumped on the video, and we wanted to pull out kind of a run-of-the-mill but yet well-known dividend stock to kind of use as a basis of comparison. And really, what it comes down to is you're not necessarily.
I wouldn't call it run-of-the-mill. Now, this is drum roll here leading into the stock. We haven't announced it yet, but we actually chose this stock because it is known to be somewhat stodgy and conservative. It's not necessarily a flashy stock.
Right.
Without giving away too much, they sell Band-Aids, for crying out loud. It is this is a stock that's been around for, I think the company actually started around the time of the U.S. Civil War. I mean, this company has been around forever, and it plods along, does its thing. It's a very stable, conservative, boring stock, making it somewhat bond-like, if you will.
Exactly. It's very well known, but it is, it is very generic, if you will. No pun intended once I reveal what it actually is. And we want to take that and we want to kind of compare, percentages, what you would be looking at in terms of a return with this dividend paying stock compared to what you'd be looking at a rate of return for a traditional bond. So the stock we looked at was Johnson & Johnson. It trades the New York Stock Exchange. It trades under the ticker JNJ. And first, what we did is we kind of plugged things into a bit of a calculator that you can find anywhere. And it takes, the investment amount using today's current stock price. You can put in the number of years that you're going to hold, it'll calculate the expected dividend yield at present. Then you can toss in other factors as well. We want to keep things very, very simple. And with what we're going to show you here, the share price as of what we're looking at today when we record this, the share price is about $178. And we want to use a $10,000 investment, which is average. I mean, it's not, you don't have to put 10,000 in. The percentages will all work out the same. So that gets you about 56 shares, a little over 56 shares. And we do this over 10 years because the most common treasury bond is a 10-year bond. That's the one that's most talked about. So we use 10 years as our time frame. Expected dividend yield is about 2.4%. It's distributed quarterly. We have no annual contribution. So basically, you're not going to add anything more to it.
You're one and done.
You
put your 10 grand in and you're just going to let it run.
Exactly. And then we have I calculated averages in terms of the average dividend increase and the average stock price increase, and I use 5% for both of those. Is that necessarily accurate? No, but it is an average. It's kind of what we expected. What we can see.
Let's again caveat that. That's roughly in line with the long-term averages. It doesn't mean that over every 10-year period the stock's going to rise exactly 5% a year. It never works out quite like that. But over a 10-year period, that's generally going to be a reasonable estimate based on the past.
Exactly. And what we come up with here with this calculator is that using all those parameters, the end balance after 10 years, you'll take your $10,000 and that will grow to about $16,288 as a total investment. So you're looking at a total return of around 62, 63%. Which is, but again, yeah, there's always a but. So
that's assuming that you've been taking those dividends along the way as income. So remember, we're doing this as an income example. So you've been, every quarter they pay that dividend, you sweep that into your bank account for spending money. Even so, even while you're continuously taking money out of the account for spending money, that's what the shares would be worth, just assuming, again, 5% annual appreciation. So you would have gotten over 60% gains in one of the most conservative stocks in the market, while also collecting that income and spending it. That's assuming no reinvestment.
So, and if you use that, and we'll just tell you, if you were to use a dividend reinvestment program to basically take your dividends every quarter and then just automatically invest those back into your position, your total return would look more about like 112%, give or take. So there is a difference.
Yeah, and why would you do that? So, for example, let's say you're not in retirement yet. Let's say you're getting the pieces in place for retirement. Then reinvesting those dividends, what does that do? It gets you more shares. Every time you get that dividend, that's put into more shares, which then gives you a bigger base to collect more dividends, which gives you a bigger base for even more dividends, and it gets that compounding working for you. So, that's great. Of course, it's kind of depends on what you want to do, though. If you're pre-retirement and you're looking to still grow the capital base, dripping is a fantastic idea. If you're already in retirement and you need spending money, then just take the dividends in cash.
So there's your difference there. Now, if we switch gears and look at a 10-year treasury note and use the same $10,000 to over 10 years, and I know that yield right now is one thing, but just kind of keep on an average, use an average of about 2%. For the expected interest rate. That can also obviously go up, it can go down, it does fluctuate. If we do that and you look at it on a semi-annual payout basis over 10 years, you're looking at about a return after that 10 years of about $11,500, $11,600, give or take, and
that's
right
after
at a
tax.
20% return.
Yeah,
and that's after that's after taxes.
Yeah, so you're looking at, just very simple math, 2% yield, assuming no compounding, you're just collecting it. 10 years, you're looking at a 20% return. So, and also there's no capital appreciation. That's just the income part, right? And that's a key part. So, if you're, the JNJ stock and that treasury note, you're getting, let's just call it a comparable amount of income. It's not going to be the same, but comparable. It's in the same ballpark amount of income. That same amount's going to be hitting your account every year. The difference being the treasury note is not going to appreciate in value if you hold it to maturity. If you hold it to maturity, you get it at par. If you bought it at $1,000 par, it's gonna cash out at $1,000 par at the end of its life. There's no room for capital appreciation. Whereas with the JNJ stock, if the future looks anything like the past, that stock will be worth considerably more in 10 years, 20 years, 30 years, infinity years than it is today.
So the bottom line here is that in most cases, I think for what you're saying here is that, in terms of comparing stocks versus bonds on an income basis, if you're just looking at it just strictly for income, stocks are probably the way to go. Dividend paying stocks.
And again, to repeat why. So apart from just, let's say you're starting at a comparable income amount, the dividends, if it's a healthy company, should rise over time so that payout gets a little bit higher every year. And then the icing on the cake is capital appreciation, which, that's at the end of the day, who doesn't want capital appreciation, right? And one somewhat overlooked element as well is tax. So if you're holding all this stuff in an IRA or 401k, it doesn't necessarily matter. But if you're doing this in a taxable portfolio, dividends are taxed at a preferential rate. Depending on your bracket, it's either 0, 15, or 20%. Now, bond interest is taxed at your marginal rate. So if you earn a lot of, if you're a high income earner, you're getting hosed there. You could be paying well over 30% of your interest earnings there. And by the way, it's fairly meager to start with. We're only talking about 2% yield here to start with, and you're potentially giving well over 30% of that away in taxes if you're in a high bracket.
And so that's kind of where we come to, and that's where we'll put a close on it here. I do want to say that next week, what we're going to talk about, which kind of directly correlates here, is we want to talk about asset allocation, meaning what kind of assets should you be holding in your portfolio under different circumstances. I mean, right now we're looking at a market that is very much in flux. So what should your portfolio look like? Very much so.
This is one of those fundamental basic concepts in finance, but it's also one of the most important, and it's also very commonly misunderstood. So
very much so.
This will be an important one.
And so we're going to talk about that next week. If you have a specific question about asset allocation for your portfolio that you'd like Charles to kind of to dive into, email us. The email address is feedback@moneyandmarkets.com, or you can comment down below here on our YouTube channel. If you do submit a question and we use it, we're going to hook you up with some very cool Money and Markets gear. We've got hats, t-shirts, sweatshirts, all sorts of great stuff we will hook you up with. And this goes for any of our videos. If you want to ask a question about a cannabis stock, we use in the Marijuana Market Update, or maybe Ask Adam Anything, or even maybe our Stock Power podcast, which comes out on the weekend, then we will hook you up with that gear. Also, check out moneyandmarkets.com. It is your home for safe, sound, smart, simple, profitable investment information. We are looking to find you ways to profit in any market condition, whether it's up, whether it's down, doesn't matter. We want to try to find ways for you to find gains in your portfolio. We use our proprietary Stock Power rating system, which you can too for free, all at moneyandmarkets.com. So for Charles Sizemore, he is the co-editor of Green Zone Fortunes. I am Matt Clark. I'm the research analyst for Money and Markets. Until next time, everyone, safe trading.